The UK budget just dropped, and if you're paying over £250,000 a year in tax, then Rachel Reeves just triggered a massive tax spike that will cost you hundreds of thousands of pounds. A brand new council tax on high value properties, dividend tax up, property income tax up, and income tax thresholds frozen for another 3 years. And these stack, meaning that the more wealth you have, the harder this hits. So in this video, I'm breaking down the 5 new tax changes that are hitting people who are already paying the most in taxes, and what to do about it. Before we get into it, I've put together a complimentary guide covering the 5 hidden problems with UK-only business structures and a checklist to assess whether your wealth is actually protected. Link in description. And now, onto the 5 changes. First, and this is the surprise that nobody saw coming, a brand new council tax surcharge on high-value properties from April 2028. If your property is worth between £2 and £5 million, you'll pay an extra £2,500 per year. Over £5 million, that's £7,500 per year. This didn't exist before. This is a brand new annual tax targeting fewer than 1% of properties. But if you're watching this video, you're probably in that 1%. Own a £6 million London home, that's £7,500 every single year that you weren't paying yesterday. Secondly, dividend tax rates increased by 2% from April 2026. The ordinary rate goes from 8.75% to 10.75%. The upper rate goes from 33.75% to 35.75%. If you're a business owner extracting profits through dividends, and most of you probably are, then this is a direct hit on how you pay yourself. On the 500k in dividends at the higher rate, that is an additional £10,000 per year. On £1 million in dividends, an extra £20,000 every year. Third, we have property income tax rates increased by 2% from April 2027. Basic rate goes from 20 to 22%, higher rates from 40 to 42%, and additional rates from 45 to 47%. If you have a property portfolio generating 500k in rental income at the higher rate, that is an additional £10,000 per year in taxes. $1 million in rental income, an extra $20,000 annually. If you're a landlord or property investor, the government just made your entire strategy 2% less profitable permanently. Fourth, income tax thresholds frozen for another 3 years, now until April 2031. This was supposed to end in 2028, and they just extended it. So as your income rises with inflation, you get dragged into higher brackets, even when your real purchasing power doesn't change. This is called fiscal drag. If you're earning 500k to $1 million, you're losing an additional £4,000 to £7,000 per year, compounding every year until 2031. That's 6 more years of stealth tax that doesn't show up as a rate increase. Next, we have salary sacrifice for pension contributions capped at £2,000 per year from April 2029. If you've been using salary sacrifice to reduce your national insurance bill on pension contributions, you'll now pay NI on everything above £2,000. That's 15% employer NI plus 2% employee NI on the excess. The Treasury says this raises $4.85 billion by 2030, and it's coming directly from high earners using this strategy. So what does this actually cost you when you're paying over £250,000 in tax? High value council tax. Own a £5 million property, that's £7,500 per year, a tax that didn't even exist yesterday. Dividend tax increases. Extracting 500k to 1 million through dividends, that is £10,000 to £20,000 extra each year. Property tax increase. 500k rental portfolio, add 10,000 per year. $1 million, add 20,000 per year. Income tax freeze extended. £4,000 to £7,000 per year in fiscal drag, compounding for 6 more years. Salary sacrifice cap. Potentially thousands more in NI depending on your pension strategy. So your total impact over the next few years is £100,000 to over £500,000 depending on your income mix, your property holding and dividend strategy. And remember, these don't replace each other, they stack. So what can you do about it? There's 3 immediate actions. First, review your dividend extraction strategy now. Second, if you have a substantial rental income, evaluate whether your current property holding structure is optimal. A 2% increase permanently changes the maths on UK property investments. Third, if you believe that the UK system has you trapped at these tax levels, That's the biggest and most expensive mistake. There are compliant international structures specifically designed for people paying over £250,000 in annual tax. But you need proper cross-border architecture, not UK-only accountants who only know domestic rules. The free guide that I mentioned breaks all of this down and has an action checklist. Link in the description. Within the next 48 hours, I'm releasing a video showing exactly how we restructured 3 of my clients' UK businesses to reduce their tax and protect their wealth. James was paying over £1 million in tax annually. We showed him that he wasn't trapped and protected a £35 million estate. Joseph was running a £1.2 million business, felt completely stuck. We restructured his income and dropped his combined tax from 45% to just 21%. Richard had a £4 to £8 million business payout on the way. Pre-exit planning saved him over £800,000. Subscribe so you don't miss it. The link to the guide is below, and if the video is already out when you see this, it'll be on screen now.